Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can follow me on Twitter and talk to me on Patreon. Alright, let's just take a look at these Rivian financials. Now first, to be clear, I'm not some Tesla fanboy that hates all other EV competition and simply wants Tesla to be a monopoly. The industry is big enough for everyone. In fact, I really like the Rivian and hope that they succeed. I just wanted to go through some updated analysis on Rivian and see how they're progressing. If the results don't look good, it's not my intention to put Rivian down, but more so just give us an idea of how good a job Tesla really have done and likely how much everyone else is struggling still. We thought that Rivian may have had a chance because they're going the same path as Tesla, except they had the luxury of being able to skip the Roadster equivalent step due to so much available financing and went straight to the Model S equivalent, the Rivian R1T. Except this is actually a lower price point than the Model S and X, even after their recent price increases. Remember, the Model S and X never hit volume production, yet still reached a net profit, although Tesla had more margin and lower OPEX. Also, Tesla were at a run rate of around 100,000 a year back when they hit profitability. The Rivian is an exceptional car for the money. It has so much utility built in, a lot that was not previously possible with ICE cars, or at least a whole lot harder. It's a new product that offers new application. It is catered to lifestyles. So perhaps Rivian's price point should have been higher. The recent price rise Rivian had to make was due to them not realizing just how expensive it is to make EVs. It was not associated with inflation. It was just like, hey, we have absolutely no chance of ever breaking even at these prices. We have no choice but to raise the prices. And with the quantity of supply they offer, they can certainly raise their prices and will still have enough demand to buy all their vehicles. This is a coveted product. Rivian has actually copied Tesla much better than legacy autos. In the cabin it is minimalist with few buttons. There's a large touchscreen, and they even made it widescreen, something that seems terribly difficult for so many others. Yes, I have no problem with Rivian, and I think it is probably the nicest pickup truck in production today. Rivian have under 100,000 pre-orders, which is a lot less than the Cybertruck or even the F-150 Lightning, but it's still plenty to keep them going at their current production rate. So far, Rivian have managed to produce around 2,500 vehicles, with a 25,000 target for this year, and the more they ramp up, the more significant will be the losses. Alright, well let's take a quick look at the financials. I thought we could compare them to Tesla's so that us Tesla investors can once again appreciate how good a job Tesla have done in the EV industry. And for those of you Rivian investors, this could be interesting for you too. How about we take a look at some of these expenses then? Rivian spent $547 million in R&D in Q1. That's really an insane amount. Even in 2020, Tesla was only spending half of that amount. 2 years ago, Tesla had no Model 3 in volume production, along with a Model Y ramping up and the S and X. Tesla were also investing heavily into FSD and battery cells. Yet somehow, at this time, Tesla still managed to spend half of what Rivian are spending today. Also, Tesla has already done so much of the research for them already, they can just copy the patents. A message to all EV OEMs, copy Tesla or go bankrupt faster. And this R&D expense, well, it was accompanied by an equally fat SG&A at another $530 million. I kid you not. Again, Tesla's SG&A was not only 1/10 that, it was half of 1/10 that, whilst they were ramping up the Model S and X. And Tesla's R&D was 1/10 what Rivian was spending at this time. Are you starting to see what might happen here? Anyway, each quarter Rivian have an OPEX of $1 billion. This needs to be funded by their cars they sell at a loss of $450,000 per vehicle currently. They have until they run out of $17 billion in cash to achieve that. If Rivian can achieve a run rate of 10,000 a quarter by the end of this quarter, which is even higher than their actual targets, then they would need a gross profit per vehicle of $100,000 just to cover the OPEX. Of course, some of these orders will be Amazon's van, which may have a lower ASP than the trucks. But if Rivian achieved a gross margin of 25%, which although is high in the industry, I think possible with a price point that they have, and if Rivian had an ASP of $80,000, then that's $20,000 gross profit per vehicle, which would mean Rivian need to make 200,000 of these vehicles a year just to cover the OPEX of the business when it was at a run rate of 10,000 a year. Of course, with more ramping up will come more cost. So in reality, I don't think Rivian can come close to break even before they start producing in excess of 250,000 units a year. However, they would need to sell all those vehicles too, and at those quantities, Rivian likely had to find a lower price point and thus reduce gross profit due to a lower ASP, which means they would have to sell even more of these vehicles. As a Rivian investor, you need to ask yourself whether you see a clear path to Rivian reaching 250,000 units a year, and can they do that within a few years before they run out of money? Personally, I think that target is far too ambitious. In order to achieve this, Rivian will need a more mass market vehicle, likely an alternative to the Model Y, with more lifestyle application built in. Rivian are looking into LFP cells, which may reduce cost, but I don't think they'll have enough energy to power these trucks. Perhaps they're being designed for the Amazon vans, given that they'll do so much more driving, and then the LFP cells will give them additional life. The question is, how long will it take Rivian to reach this run rate? Rivian's current footprint means they can produce 150,000 a year by 2023, with an additional plant coming, taking it to 400,000. Wow, that's a lot of investment in growing a product that makes a really massive loss. They also seem to believe they can deliver 25,000 vehicles this year, despite only being around 10% the way there so far. They're also aiming for 1 million a year by 2030, with what they call a 10% of the EV market share, implying the EV market is only 10 million by that stage. I'm not entirely sure I agree with the math there on the EV industry size, nor Rivian's projected market share. But is this what people believe? Is that how this company wore such a high stock price at one stage? Rivian will never have 10% of the EV market, but if they last long enough, it's perhaps possible they do reach 1 million a year. Right, 1 million a year, is that possible? Well, not at their current price points, of course, but perhaps they do have a good enough brand and have differentiated themselves in the market well enough that they can have prices for their EVs that are high enough that they actually generate a profit. I think 20% margin might be about what we can manage though. Perhaps with an overall ASP of $60,000, then we're at $12,000 gross profit per vehicle. If they sold 1 million vehicles a year, then they have $12 billion gross profit. If OPEX only doubled where we are today, then there might be about $4 billion net profit after all that, possibly after tax too. Wow, $60 billion of vehicles sold to just squeeze a $4 billion profit, plus the previous couple of decades of work and investment in getting there. Well, I think the saturated EV industry gets a PE ratio of 20. Therefore, Rivian still only gets an $80 billion valuation, even after all that. Or about 3 times return from today. So you wait 10 years for this company with the risk of losing it all, and then if everything goes well, you might get a 3 times return, which probably is pretty close to the S&P 500. Oh, also, this is already when it's 1/5 the value of its all-time high, which is why I was warning everyone about Rivian when the IPO occurred. In my opinion, Rivian just has too high OPEX. It is going to be incredibly difficult to make enough gross margin on all those vehicles to cover the OPEX. I think eventually this will become more apparent and the stock will implode. I think Amazon will buy the company for pennies on the dollar and use it to produce their own electric Amazon delivery vans. I don't think the Rivian trucks will be produced any longer, or even the name Rivian remain, due to them simply not being profitable. I also think it's a shame. Like I say, I'm really not against Rivian. I'm not a Tesla fanboy that simply hates anything non-Tesla. I'm a realist who wants to see a cleaner future and don't want Tesla to do it alone. If I sound negative about Rivian, then it's the financials I'm negative about, or investing in the company I'm negative about, not the actual specific product or company. The company does cost an absolute fortune to run though. It has a high-priced product, which likely needs to have the price raised further again to hope for a profit. These high-priced luxury items may suffer somewhat during a recession, although the chances are that we leave the recession before Rivian has ramped up their production anyway. Tough times ahead, but a lot of cash too, except at that burn rate it won't last too much longer unless they can pull a rabbit out of the hat. I wish them all the best, but as an investment, to me, this looks like a risk of losing everything, which I'm okay with if the potential odds are in my favour enough, which they don't appear to be. There isn't really anything exciting that pops out to me about this company. I can't see a path to profitability for this company before that war chest depletes, and I certainly see absolutely no reason to invest in Rivian over Tesla. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.